What a year! Not only are we currently living through a once-in-a-100-years pandemic, which came only about 3 years after a once-in-a-100-year drought, which itself was preceded by less than 10 years by a once-in-a-100-year financial crisis. And not even to mention the once-in-an-era climate crisis brought about by the human impact since the pre-industrial age. As can be expected, these extreme events create a lot of volatility in the global capital markets. This is why alternative investments are must-have strategies in any investment portfolio. From 31st of October to the 12th of November 2021, many of the world's nations joined the 26th convening of the United Nations Conference of the Parties, COP26 for short, in Glasgow, Scotland. The main goal of COP26 was to accelerate action towards the goals of the Paris Agreement and the United Nations Framework on Climate Change. Momentum Metropolitan Holdings is a proud signatory to the United Nations Principles for Responsible Investment. Furthermore, whilst the United Nations has identified 17 Sustainable Development Goals, MMH has identified 5 of these SDGs on which we have a direct impact, namely good health and well-being, quality education, decent work and economic growth, industry, innovation and infrastructure, and climate action. Whilst our update today is not about climate change, ESG, or the Sustainable Development Goals, alternative investment strategies provide us with a unique ability to execute and drive these principles and policies, as well as giving us access to numerous investment opportunities for our investment portfolios. Momentum Investments manages a number of impact funds, which my colleagues have introduced to you over the course of the past year. These funds also specifically speak to MMH's identified Sustainable Development Goals. Our Social Infrastructure Fund was the first investor in the South African Student Accommodation Impact Investments Fund, which delivered its first project in 2019 already. These are 2 photographs of the student accommodation development called Units on Park in Hatfield, close to the University of Pretoria. Development work has also commenced on 2 further projects, one in Braamfontein in Johannesburg and the other in the Cape Town city centre. The fund also made progress in bringing on additional investors in the form of a large South African pension fund, as well as 2 international development finance institutions. The fund was able to make its first dividend distribution and shareholder loan repayment during the course of the past year. Our Diversified Infrastructure Fund participated in a co-investment opportunity into Community Investment Venture Holdings, a large infrastructure provider, as part of CIVH's capital raise, as can be seen in this slide. The business continues to perform well, and the additional capital was raised to optimize the balance sheet and unlock the additional debt facilities to fund growth. The more mature investments in the Diversified Infrastructure Fund, such as the toll road assets such as this one, the N3 toll concession running between Johannesburg and Durban, as well as the Umoya wind farm near Hopefield in the Western Cape. These investments performed as we had expected, with a strong distribution yield of around 13% on both the toll roads and the renewable energy assets. Traffic volumes on the roads improved back to normal levels throughout the year, after being down around 40 to 50% during the hard lockdown. Our Alternative Energy Fund consummated its first transaction in November 2020, which comprised an investment as part of a refinancing package for an equity investor in a round 1 renewable energy project called Karoshoek Solar 1, located close to Uppington in the Northern Cape. Performance over the past year was in line with expectations, yielding a steady 15.5% net IRR. The Alternative Energy Fund has also received its first distribution from this investment. For the impact funds, we are looking to build out the portfolio with additional investments across these 3 sub-funds. The deal pipeline includes more opportunities in the renewable energy, water, and affordable housing space. Next up, our Special Opportunities Fund, which invests in corporate credit as well as the equity positions of unique property development opportunities, and a Special Situations Fund. The fund boasts a 62-month track record, delivering an annualized return since inception of CPI plus 5.3%. As can be seen from this slide, the Special Opportunities Fund is a consistent performer over all the relevant time horizons since inception, underpinned by the credit portfolio's instruments comprising floating rate notes. This kind of consistency is what we are looking for from our alternative investment portfolios to ameliorate the volatility in the global markets. The equity positions are in all various stages of value creation and realization, which is expected to lead to an uptick in performance as these liquidity events occur. This slide depicts the asset allocation at the time of investment with the post-investment yield accrual and uptick in valuations over the life of the fund. Similar to the impact funds and private credit funds discussed earlier, private equity investments also aim to capture the illiquidity premium over the long term whilst reducing the volatility of the investment portfolio. It achieves this lower volatility due to the fact that there is no frequent buying and selling of the underlying investments. The valuations are typically performed on a quarterly basis in arrears, and which typically lags between 3 and 6 months. And lastly, these valuations are typically based on some multiple of maintainable earnings of the company and is consequently less volatile. But private equity investments are not immune to the macro factors, and valuations and deal activity also contracted sharply in the immediate aftermath of the onset of the COVID-19 pandemic. Whereas the public markets bounced back sharply after the low of February 2020, private equity deal activity only started picking up strongly in the second half of 2020, again lagging by roughly 6 months. Investment activity further accelerated strongly in the first half of 2021, when the global transaction value was estimated to be close to $584 billion, setting up 2021 for a bumper year of deal activity. Similar to our global counterparts, South African private equity also contracted sharply in the aftermath of the global financial crisis, both in terms of value and volume, before a strong run from 2013 to 2018. Unfortunately, local factors led to an initial contraction in activity in 2019 already, which was compounded by the COVID-19 pandemic in 2020. Momentum's Private Equity Fund 3 started off well in 2016 with a secondary partnership acquisition, and these early wins demonstrate the uncorrelated nature of alternative asset strategies. Fund 3's returns moderated somewhat, though not unexpectedly, and we were pleased that we had managed to mitigate the J-curve effect relatively well. As mentioned earlier, private equity investments are not immune to the global macro factors, and valuations contracted similarly to public markets, although with a bit of a lag. Whilst public markets bounced back strongly in a V-shaped recovery, our portfolio showed a more U-shaped recovery and is slowly closing the performance gap. We are comfortable that the underlying portfolio companies are fairly conservatively valued at multiples that are significant discounts to their public market peers. We consequently expect our private equity portfolios to continue its recovery as the underlying portfolio companies also implement their respective strategies to optimize their operations to a post-pandemic world. The correlation to the public markets re-established at the pre-pandemic low levels, with a correlation of 0.06 to the Indy, 0.25 to the Aussie, and 0.31 to the Capped SWIX index. Over the past year, the volatility of the Private Equity Fund 3 is roughly 52% of that of the All-Share Index, speaking to the aim of lower volatility of alternative asset strategies. Whilst exposure to alternative asset classes such as impact, infrastructure, credit, and private equity can reduce the volatility of investment portfolios, if there's one alternative asset class that can exploit such market volatility, that would be hedge fund strategies. This slide shows the distribution of returns of the JSE All-Share Index over the last 5 years and over the 10 preceding years. As one can see clearly, a shift in the distribution to have a fatter left tail and a lower peak in the distribution. Such lower peaks and fatter left tail are indicative of higher market volatility. In this environment, hedge funds offer enhanced capital protection, greater diversification, and the ability to trade around negative news flows. Our hedge fund range has had a strong 12 months, outperforming the respective benchmarks over the period. The products offer three distinct risk-return profiles: a cash plus profile, a hedged equity offering, and an enhanced equity offering in the portable alpha strategy, which aims to outperform a passive capped SWIX benchmark. All strategies contributed positively, with the fixed income arbitrage being the strongest contributor for the last 12 months in the multi-strategy portfolios. This performance was not without volatility, as the global inflation outlook and stimulus withdrawal talks created volatility and opportunity across global markets. Looking forward, we expect the global news flow to continue to dominate local market sentiment. For the fixed income strategies, fears around more structural inflation trajectory are bound to create greater volatility, but also more opportunity, as these fund managers are able to take short positions in anticipation of any weakness. We continue to favor these strategies on the back of these wider mandates. The equity strategies also contributed strongly, having benefited from a wide range of factors. The increased volatility was a positive for relative value trading strategies, being able to take long and short positions in the related securities. We saw increased event-driven opportunities, and the strong resources performance favored the macro thematic strategies. We are seeing a shift towards more defensive positioning, favoring ZAR weakness, given the increased global risks, and we continue to hold these volatility-sensitive strategies, ensuring diversification to a range of return drivers going forward. In conclusion, during such uncertain times and volatile times, when these once-in-a-100-year events seem to be occurring more frequently, using alternative asset strategies can reduce the volatility of your investment portfolios and, in some instances, exploit the volatility for the benefit of our investors. Thank you.